Hey everyone, happy Friday. It's Friday, November 18th. Today on the final bar, we'll wrap the week. We'll look back at the last 5 trading days, break down what all has happened. Nice strength going into the close, setting up for a holiday week next week. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com in a sunny and cold Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. StockCharts and the technical analysis toolkit is designed to empower you as an investor to better understand investor psychology, better manage your own emotional conditions, and make better decisions using the best practices of the technical toolkit. We'll apply all of those as we wrap the week today. A nice up move through the course of the day yesterday, sort of continuing on sort of a U-shaped day to the overall trading with a sell-off in the AM and a rally in the PM. Overall, the market's moving up just a little bit going into the holiday week next week. Tends to be a stronger week for stocks in general, but usually a little lighter volume. So usually don't expect too much turbulence on a shortened holiday week. But overall, a lot of question marks as the S&P is rallying and has rallied up to its 200-day moving average. We'll get to the charts here in a few moments, but did want to let you know about the upcoming schedule. We had a packed week this week. Larry Tentarelli, Ryan Dietrich, Julie Stekempener, 3 of the best guests that we have. So if you missed those, make sure you check them out. Next week on Tuesday, we're going to have Ari Wald from Oppenheimer joining us on Tuesday the 22nd. Wednesday through Friday next week, we'll be taking time off for the Thanksgiving holiday. Wish you guys all a great safe holiday season, of course, and then we'll be back the week after Thanksgiving with Stephen Bigelow, an expert in candlestick analysis, and Javed Mirza from Canaccord Genuity in Toronto. Also, our latest episode of The Pitch, by the way, was just posted to our on-demand platform on our YouTube channel. So if you missed that one, definitely check that out. It was a really fun discussion earlier this week. Let us wrap the week and focus on how the last 5 trading days have evolved. What did we learn about the big picture? But let's start with a poll question. We asked you recently on our social media accounts. So assuming Twitter is still up and running next week, give us a follow there. And also on our YouTube channel, subscribe there and you'll make sure you get all of these polls. We asked you which asset class performs best over the next 3 months. Stocks, bonds, gold, or the dollar. And I gave you some ETFs or common indexes to reflect on each of those. Over half of you, 60%, just under that, said the S&P 500, which I thought was very, very interesting. 26% saying gold, bonds 14%, and the dollar 2%. So I have 2 observations on this one. Number one, not as many picked gold as I thought, which tells me gold is still very much an unloved chart. When I look at these 4 charts, though, and think about which one has been certainly underperforming, but has really started to rotate higher in a pattern of distribution to accumulation, gold would probably be the one I would be highlighting more than anything. So I would probably say the GLD if I was voting here. I'm also noticing that only 2% of you said the dollar, which means you're all kind of buying into the weaker dollar continues, stronger stocks, which is very much a possibility going into the first quarter of next year. That is 100% possible. But boy, what if that doesn't happen and we're all caught on the wrong side of it? That's the risk to the downside to this market, which is why it's never a certainty. By the way, on my YouTube channel called Market Misbehavior, just last night, I posted a choose your own adventure style video, 4 scenarios for the S&P from very bullish to very bearish. Check that out if you could and vote on which of the scenarios you see is most likely and why. It's a lot of fun to think about the different possibilities for stocks, and I think that question will probably come up in your thinking. Let's continue on with our exercise of wrapping the week. 3 pieces to this. We'll start with just checking in on the action today in the markets. We'll then look at the last 5 trading days and reflect on the overall trends that we've seen and what we learned. And then we'll go through my Mindful Investor live chart list. That's a list of charts I update on StockCharts, and we'll see what wisdom we can glean from that. Looking at the markets today, decent day for the S&P, up 0.5%, but no real groundbreaking move either way. We're up to 39.65 on a closing basis, briefly above 39.70 at the open, and a little bit before the close, but settled in a little bit below that. The NASDAQ composite actually flat for the day, along with the NASDAQ 100. So it's worth noting sort of the growth he said. When you look at the FANG stocks, they're not bad, right? They're not breaking down like in Netflix, right? It's not really going down a ton. It's just stopped going up. And I think that might be an interesting thing to pay attention to in the next couple of weeks, because I would argue the market's going higher from here, playing on that seasonal trend, which tends to be pretty strong, right? Markets tend to be strong after the elections into the end of the year, in a midterm election year, which is what 2022 truly is. However, I think it would have to be most likely the FANG stocks participating in some way. And at least for now, going into the weekend, not a great read from those. They're weaker rather than stronger going into the close today. Mid caps and small caps both up about the same, a little bit more than the large cap index. And the VIX pushing back lower. And that could be an interesting thing. A lot of the days this week, the S&P and the VIX actually moved in concert, where they'd go up or down together. Today it's back to its traditional sort of relationship where the S&P is up, the VIX is down, and vice versa. The VIX of 20 is a level we've talked about. We talked about that in our segment on sentiment on Thursday's show. So if you missed it, go back and check that one if you could. Interest rates moving a bit higher today. 10-year yields pushing up from yesterday to close the day just above 381, and we're at 393 on the long bond yield. Bond prices moving lower. The dollar index up, not by much though, about 0.25% higher than yesterday. Commodities all in the red here. The DBC, which is a broad commodity ETF that we track, down about 0.7%. Gold, which we've talked about a great deal recently, also down about 0.7%. Oil prices down as well. And energy was the worst performing sector, even though year to date, again, it's not even close. It's by far the strongest sector in 2022. Mixed results and relatively low changes on the cryptocurrency front. Bitcoin trading lower through the course of the last 12 hours or so, and currently just above 16,600, just above 1,200 on Ether. Let us go to the wrap the week chart. So I like to just look at the last 5 trading days. And what we do on the Friday show, by the way, is just a brief kind of taste of the kind of work that I do every week as I'm preparing for sort of my own weekly routine of making things, writing a note for my premium members at Market Misbehavior, and getting ready for the week to come. This is sort of touching on some of the charts that I would reflect on as part of that process. So this one is looking at the last 5 trading days, just thinking from Friday to Friday, what did we learn this week, right? What changed? What's moving? What's an outlier? What's moving together? And just think about what that might represent. The S&P finishing the week down 0.6% after Friday's close on November 11th. A couple things outperformed the S&P this week. Emerging markets were down about 1/3%. 2 things were up on absolute basis on the week. The dollar index is actually using the UUP, which is a bullish dollar ETF, was up about 0.6%. And then in red, we have bond prices. This is the long treasury bond ETF, up 1.8%. So bonds, the best performer of this group of asset allocation style ETFs. Everything else underperformed the S&P this week. These two are about the same. Gold and NASDAQ stocks. This is the NASDAQ 100 and gold, both down about 1.1%. Here in purple is small caps down 1.7%. In navy blue, we have Bitcoin down 2.2%. Then the worst performer of the group is the USO, which is a crude oil ETF, which is down 7.2%. So again, oil and energy prices, while having and again, oil and energy have not necessarily been moving together for a lot of 2022. Directionally, at times they have, but 2022 has been a fantastic year for energy stocks. Not as much for crude oil, particularly recently, while a lot of the energy names are testing all-time highs. So crude oil prices down actually 7.2% this week. We will continue this Wrap the Week segment looking at the Mindful Investor Live chart list. This is a list of charts that I keep updated on the StockCharts platform. You're welcome to access them at any time. Just go to my blog, which is under the Articles tab called The Mindful Investor, and you can access this list of charts at any point. Starting here with our market trend model, this is looking at basically the S&P 500 on a weekly basis, looking at 3 time frames: long-term, medium-term, short-term. And I've explained, I update the model every Friday, reflecting on any changes in it. And we did have a change this week, which I'll tell you about here in a moment. The short-term model has been bullish basically for the last 5 weeks, and so continue to reinforce a bullish trend in the short term. The strength in the market this week has basically turned my medium-term model back bullish. And in general, that's my main risk-on or risk-off model. So when this is positive, it tells me to think risk on. When it's negative, it tells me to think risk off. It's been risk on just 2 other times in 2022. The first one was in late March, which was this peak here. The second time was early August, which was right before this peak here. And I'm uncomfortable to see that this is the third time it is turning bullish, basically in a similar sort of what I would describe as a bear market rally. Now, here's the thing. In a downtrend, the beginning of the big recovery, right? The end of that downside move and the beginning of the next move higher is going to look like a bear market rally until it doesn't, right? And that's where you look at the sustainability of the move, the confirmation from things like momentum and breadth and other things, and also just the trend, right? Can the price break above the 200-day as opposed to stalling out at the 200-day, which is what happened in August. So the fact that the medium-term model turns risk on for me tells me, again, in general, to start thinking risk on with positioning, to be looking more aggressively for long ideas. But also, I think in 2022, in a cyclical bear market, which I still have to label it that way until we see a little more improvement, it tells me to be wary and start to think about the similarities between right now and some of these previous bull market moves, tactical rallies within the downtrend. But worth noting, medium-term trend model for me turning bullish today. The daily chart of the S&P really shows you how this week didn't really tell us much in terms of the overall move, right? End of last week, that was last Thursday and Friday, which sort of accelerated up to that 4,000 level. We really didn't close above that, right? So actually closed down on the week a little bit. This was sort of a choppy consolidation phase. So the way it went, on a Friday, take a step back from what we saw this week and just look at what really has changed. So a couple observations more on the longer term. Number one, this week really didn't move. It moved around, but directionally, we didn't change from where we were a week ago. We're in the same range that we were last Friday. We hit 4,000 a week ago, and we've not broken above it. So far, 4,000 really established as a key resistance level. And that's actually based on Fibonacci retracements. A number of different measurements all point to 4,000 as a key level. So I'm not terribly surprised that that's where we have found resistance this week. But it also tells me if and when we get above there, if next week we see further demand and we see the price move above there, if we see the RSI move above 60, this could certainly be the beginning of that signal, which tells us that it's not just a bear market rally. It's something more meaningful, right? It's something more significant. But bear market rallies tend to stall out at resistance. Bigger rallies that have staying power break through resistance as additional buyers come in and push the price higher. That's the open question I don't have the answer to yet. I think the markets in the next couple of weeks will tell us. The Fibonacci retracements, this shows you sort of the big picture structure that I've seen in the market. 3,800, really 3,815, 3,820 was the first objective, which we reached in May. The 50% level is around 3,500. And if and when we would break 3,500, that gets me to what I still feel is the ultimate downside objective around 3,200. Now, we get much higher. We get certainly above 4,300. I will tell you that's no longer a reasonable target. And you have to start thinking much more constructively because we've had that much of a rotation. But until then, I still see the net move is down because you're seeing this as sort of a downtrend channel, right? And that's the key to think about. We do have some tools on here. Actually, we probably won't have time to get into that, but we do have some regression analysis to allow you to show what the trend has been and think about the extremes in the trend versus the overall trend. And when you lay it out that way, we're sort of at the upper end of a channel that we've been in. Does that channel continue? The price will tell you when that channel is finally broken. Let's take a quick commercial break. We'll be back powering up your use of the StockCharts platform. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close. We're excited to bring some market observations and updates to you using the StockCharts platform. A couple quick announcements before we get on to our next segment. First off, we're going to do a mailbag segment a little later in today's show. We'll do another one on Tuesday of next week, and we would love to answer your question live on the air. Here's how we do it. Email us your questions. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, so give us a follow there and tag us in any questions that you have. And we are on YouTube. just put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show of next week. Also, go to StockChartsTV.com. This week, we had some fantastic special programming. Larry Williams posted his latest market update earlier this week. We had our latest episode of The Pitch, which just posted in the last day. All really fantastic ways, taking a step back, thinking about the markets between now and year end. On top of that, all of our regular daily and weekly programs are available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on our show today with the Power Up segment. What we like to do on Friday is power up your use of the Stock Charts platform. Today, we're going to talk about the CandleGlance feature. When I first came on and joined Stock Charts years ago as a contributor, but then 3 years ago as the chief market strategist, we were looking at different parts of the platform. And I sat down with our founder, Chip Anderson, talking about what parts of Stock Charts I really appreciated and where I felt like we could certainly stand to improve. And there are plenty of things in both of those lists. But one of the things I told them that I liked the most was called the CandleGlance feature. You can get to this a couple different ways, but if you click on Charts and Tools at the top, you'll see there's a little CandleGlance option right here in the middle. And honestly, if you are looking to get more comfortable with the Stock Charts platform, this is a really good place to go because everything is listed out and gives you different ideas to use it. So you can enter a bunch of tickers if you want to sort of look at a group of things, but I wanted to point out the predefined groups. So if you want to quickly look at the 11 S&P sectors, select S&P sector ETFs, and this gives you the different, the CandleGlance function. Now, a couple things that I'll point out here just to power up your use of this tool if you've already used it. Number one, I use a Mac. I use Mac laptops mostly in my work, but if you use a PC, there are similar tools. I don't have time to go into those, but if you're using a Mac, hold down the Command key and hit the plus or the minus. This is just a browser tool. But what I found sometimes is you want to zoom in a little bit and make the charts bigger or smaller. That's the easy way to do it, is actually just use the browser controls. So I'm often using that, holding down Command and doing plus or minus to make the charts and the things bigger or smaller. It's a great way to take a list and kind of make it look a little bit differently. The point of the CandleGlance tool is to reflect on how all of these charts are related. So I'm looking at 12 charts here, the S&P and then the 11 sectors, and I'm looking at things like which ones are outliers, right? Which ones are working and which ones are not? Which ones are making new highs? Which ones are making new lows? What are the moving averages and how they're sloped? Now, I'm doing all that because this is my custom chart, a one-year chart with the 50 and 200-day moving averages. I did that because I selected custom style up here and I put in my own chart that I wanted to use. But you can easily bring up, just a pre-canned time frame. You can add indicators in here if you would like to do it. So I could say RSI, and update, and now I can put, look at a similar look for each of these. So there are ways you can just customize very quickly and look at different things. You can also incorporate point and figure charts in here. I like to set my own custom style because I'm very particular about how the charts look. If you want to know how to do that, just above the CandleGlance, you'll see this little gray message and a blue button that says Learn How. It'll show you how to create a chart style that will be used in your CandleGlance tools. And as a reminder, you can always enter your own tickers at the top. You can use a chart list as the way to populate your CandleGlance function, or just go to the predefined groups on the upper right. So that is powering up your use of stock charts using the CandleGlance functionality. Let's continue on our show with the Final Bar mailbag. As a reminder, the mailbag is always open. The Final Bar at StockCharts.com is how to get your questions in front of us. And let's get to question number one. Dave, last month, Devon Energy, DVN, set a new high for 2022, closing at 77.35. If 77.35 now represents overhead resistance, where might DVN find support? Really good question, and thank you for sending that in. One of the reasons why this show is called The Final Bar, three reasons. I will tell you why we came up with this way. Number one, I'm a musician. So thinking about the final bar of a piece was part of the inspiration. Finding something that was related to music and the markets was an easy win for something like the final bar. The second thing is because when you are looking at a chart like this, actually the second one is it's the end of the day. So the idea is we've now printed the final bar for the day. Let's bring up the show at the closing bell. But the third and most actionable reason is because when I teach people how to look at support and resistance levels, I would always tell them start with the final bar and then look to the left, right? Start on the right of the chart and look to the left. And that seems kind of intuitive, hopefully, but we actually did academic research when I was at Fidelity. Long story short, we had a a group that would actually help us design the website for Fidelity, and they would do a bunch of eye tracking tools. They'd have people come in, use the website, and they'd actually track where you were looking so that they could see what ads worked and where they should put different tools, what colors they should make things, and it helped them make the website better and more accessible to people. We actually hooked up people to that same functionality and asked them to look at a series of charts. And we had people, kind of new investors right off the street. We had some seasoned analysts and then some expert technical analysts that worked for me on the technical research department. What we saw is when people were just getting started, their eyes were kind of all over the place, looking at the title, looking at the different indicators, looking at all the different things, and it was kind of evenly spread all over the chart. What we found with the expert technical analysts is they focused on three things. They started at the current price first, and then looked to the left. Then they went down to the different indicators, and then they saw what it was, and then they were done. And then they would make the call. It would take them a lot less time, and they would focus their attention on the most recent data and then look to the left to see what had happened before. That is part of what inspired me to help encourage people to do it that way. Start with where we're at now, 69.62 as of the close this week. You picked out the previous high, which I think is absolutely right. So look to the left. What levels stick out? That is a clear level of resistance. What are some potential levels of support? Well, clearly the 200-day moving average, which has served as support a number of times in 2022, certainly makes a lot of sense. That would be just above $62 a share. Below there, it's 55, right? And that would be this level from September. Charles Dow taught us an uptrend is higher highs and higher lows. That's the pattern DVN has been in. If we make a lower high and a lower low, which means we'd have to undercut 55, that's where this chart can look very weak very quickly. So that is how I would answer your question. Question number two, how do you actually, quote, follow the money for different time horizons? You mentioned different experts talk about following flows or following the money. Is it more the inflows and outflows to sector ETFs, the RRG, or are there different tools and tricks? Really good question. So when you're looking at something like an ETF, there are two ways you can generally, and there are probably many more than this, but a couple general ways you can make assumptions about the trend and what investors are actually doing. The most pure example, this is what John Murphy taught me in the first book I ever read on technical analysis of the futures market, now called Technical Analysis of the Financial Markets. Basically, price reflects what investors are thinking and feeling, right? That reflects the supply and demand in the market. So your best indicator of where investors are rotating is to look at price, because if everyone rotates into energy, the price of energy is going to go up because the demand has increased and the supply has not. And so as a result, that's kind of a natural measure of supply and demand. So I think that's your best toolkit. That is arguably why technical analysis works and why it should work. The second thing is to look at things like volume, right? Price and volume, and start to make some inferences about when the price moves. Is it because of the heavier volume or lighter volume? And the implication is heavier volume usually implies more institutional investors, more of the quote unquote smart money. And that could be a better measure of institutional flows. And a lot of toolkits actually use price and volume to infer, whether institutions are accumulating or distributing their positions in a particular ticker. The third piece would be to look directly at ETF flows. You can actually look at the money going into or out of ETFs, and a number of analysts do a really good job. We don't really have flow data directly on StockCharts. I actually go to ETF.com for what it's worth, and they have a really good daily and weekly flow report that tells you where assets are flowing. So those would be the different things I would use to make a little more sense of that. By the way, John Kosar, who was on the pitch this week, he actually looks a lot at ETF flows as part of his research at Asbury Research. So that's another place to look as well. Next question, is this a bear flag for the US dollar? And you know what? I remember you included a chart, and I don't have it in front of me, but it looked similar to this chart here, which is my chart of the US dollar. So I hope that's okay. And I believe what you were talking about is this pattern here. So a flag pattern is where you have a big run higher like this, and then you have a counter trend move that does this, right? So you have sort of the direction of the overall trend. You then have a counter trend channel, lower highs, lower lows on a shorter time frame than the broader advance. This is actually not a bear flag, though. This is actually a bull flag, but it's not a confirmed bull flag pattern until you exit the pattern. So traditionally, what this pattern would mean is you've rallied into this uptrend going into the pattern. You then have a potential bear flag of lower highs, lower lows. When you break out of the upper boundary, that would confirm and validate that bull flag pattern and suggest much further upside from here. The dollar index notably did not do that. It actually exited the pattern from the bottom, which actually negates that as a bull flag pattern. So you actually can't label it that way, but it is not a bear flag. A bear flag would be in a downtrend. And if you'd have a counter, like a big down move like this, and then you'd have kind of a move like that, and then down would be a bear flag pattern. So that's actually a bull flag, but was not completed. So not a valid bull flag pattern. Thanks for that question. Actually, really thoughtful one. And man, we have to move on. That was so much fun, though. Great questions, as always. Please keep them coming. Shoot us an email, anything that comes to mind, and we'll get to more questions next week. For now, we need to wrap the show. At the end of the show, every time we do the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I had a great discussion earlier today with Patrick Donawilla, who authors the chart report every day, and also has a really good podcast and YouTube channel that he started with interviews. I had a lot of fun talking with him. Hopefully that'll be posted here very soon. I'll share with you when it is. One of the charts we spent a good amount of time on was this chart right here, which is looking at the percent of stocks above their 50 and 200-day moving averages. Just want to share with you sort of the general thing we talked about. The S&P has rallied up to potential resistance, and I think we are very much at a key decision point here. Do we have enough momentum left in the tank? Do we have buyers still waiting? Do we have enough buying power, enough interest in pushing prices higher that we get above the 200-day? That would make it very different than what happened in August when we stalled out at that key level of resistance. So as we approach that level, the breadth conditions have certainly improved from about, let's say 6-8 weeks ago. We had about 5% of the S&P above their 50-day. That's now up to over 80% this week. Above their 200-day, it's at 56%. That's up from about 12% about 6 to 8 weeks ago. So when this is over 50%, that is my general measure of bullishness, right? When there's over half of the S&P above their 200-day, even though the S&P has not broken out above it yet, this indicator certainly has. And that's one of the bullish pieces of evidence, is that you've had enough of a breadth thrust off of the lows, suggesting that buying power is building. The question now is there enough to power through resistance? And that is, again, the key piece of information I think we have not confirmed yet that I would certainly be looking at. Chart number 2, Juniper Networks, JNPR. When I'm looking at big gainers today, Juniper came up on the list. I'm usually at the end of the day just scanning for stocks and looking at big movers and just trying to understand what's happened. JNPR came up on the list because it made a new 3-month high today, breaking above $31 a share for the first time since back in April, May. That was when it last broke below the 200-day moving average, and that was a great sort of indication of this negative trend after a nice run to new highs in March. Actually broke down below the 200-day. From there, it's been in sort of a basing pattern, right? Making lower lows, bottoming out eventually around 25.50, we'll call it. But from there, it's now gotten back up to its previous resistance. It got to $30 a share, broke briefly above the 200-day, and now finally gapping above there going into the weekend here. I like the setup. I like the higher low, and I like the fact that we're resolving this to the uptrend. Charts like this, I think, deserve the benefit of the doubt. Thinking about the previous question we had about DVN and where you find support, where do you find support on a chart like this? Start with the final bar, look to the left. What key levels stand out as you're looking back over time? $29 a share. That was the low close there in November. This is when we dropped down, but then immediately reversed. And I think that's an important level to watch. As long as we hold that, maybe in the shorter term, the 200-day moving average around 30.30. Those are the levels I would be watching if I would have a long position on a chart like this. To finish off Netflix, I don't mean to finish the week and the show on a dark note, but here's the sort of the clouds building on the horizon as the S&P is approaching its 200-day moving average, approaching a lot of overhead resistance. I'm concerned when I see stocks making bearish momentum divergences, which is unfortunately what I'm seeing on a chart of Netflix. If you look at the FANG stocks, the best performer by far in the last 6 months has been Netflix in terms of a chart that has been in a constructive pattern, while a lot of those FANG stocks have been struggling. Certainly the sectors have been struggling. New high in October, new high in November for the move coming off of the low in May, but lower momentum on these last 2 peaks. So October's high to November's high, you actually have a decline in momentum. That's a bearish momentum divergence, suggesting potential downside for Netflix. That might be an important chart to watch going into next week and certainly into December. That is a wrap for the show and a wrap for this week on the Final Bar. Thanks so much for joining us every weekday after the close. For StockCharts.com, I'm Dave Keller. Be safe and have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.